Did you know insurance fraud costs the average U.S. family between $400 to $700 per year? This is approximately $80 billion for the entire U.S. Insurance fraud not only imposes costs on insurance companies, but to us as consumers and society as a whole. Hello, my name is Ashley Ramirez, and the topic I will be discussing today is insurance fraud. I will be defining what fraud is, who commits fraud, as well as the implications fraudulent actions have on us as consumers and the economy as a whole. I will also touch base on the different types of fraud, the ethical dilemmas individuals face, and the unethical behavior that leads to insurance fraud, as well as the legal ramifications if found guilty. I will then proceed to review the federal legislation placed into effect to fight insurance fraud, as well as preventative measures and organizations that assist in detecting and minimizing insurance fraud today. Lastly, I will conclude by discussing how insurance fraud is being perceived today and how this may affect insurance fraud in the future. To begin, let's review the definition of fraud as any purposeful communication that devises, manipulates, or conceals facts in order to harm others. More specifically, when we are discussing insurance fraud, we are referring to when a person or entity, such as a company, makes false insurance statements in order to obtain compensation or benefits to which they are not entitled. Now that we have a better understanding of what insurance fraud is, let's discuss why someone would commit insurance fraud. The primary reason that people commit insurance fraud is to gain financially. On the individual side, some policyholders believe that their premiums are too high. So to offset what they feel are overpriced premiums, they feel justified in exaggerating losses in a claim or making up a claim to receive benefits. On the entity or the company side, some insurers perceive a majority of their policyholders will exaggerate or falsify claims, which will result in a loss of revenues for the firm. Because of this, companies may feel justified in dishonest marketing practices in order to make up for the lost profits. In both scenarios, parties are motivated by a financial gain regardless of the deceitful purpose to the other party. We will now go into depth regarding the types of insurance fraud committed on the individual and entity side. When an insurance company commits fraud, this can be done in several methods. The number one type of insurance fraud is called premium diversions. This is done through the embezzlement of insurance premiums or payments by an agent who collects payments and instead of submitting the money to the company, keeps the money for personal use. Premium diversions also include companies not paying out legitimate claims and lastly, selling insurance without the proper license. There is also fraud by sales agents in the form of omission lying, which is in the form of misleading customers to believe they are covered or protected against certain items when in fact they are not. Agents may do this simply to make a quick sale. A real-life example would be marketing a life insurance policy for $10 a month and making it appear that this premium remains the same throughout the consumer's life. However, the policy rate is only good for 5 years. After 5 years, the customer has to reapply at a higher rate, and if their health has deteriorated within that 5 years, they may no longer qualify for life insurance. A lot of times, agents will also use insurance jargon in their explanation of policies to consumers, knowing that individuals do not understand these terms. They do this on purpose to create noise to confuse individuals as to what their policy really entails. These agents are more focused on the end sale or commission versus what is right for the individual. So why do they do this? Agents may feel corporate pressures to increase sales, so there is a lack of integrity in their sales tactics. As ethical consultant David Gebler stated, most unethical behavior is not done so for personal gain, it's done to meet performance goals. So in that we realize the strong pull corporate pressures have on employees and the powerful influence an ethical corporate culture, or lack of one, can have on employee decisions. Insurance fraud committed by individuals is also very common and they are categorized as either hard or soft fraud. Soft fraud is considered the milder of the two, and it's also referred to as opportunity fraud, in which the policyholder exaggerates a claim. A real-world example would be a policyholder who has homeowners insurance and their home was robbed. When the company asks for an itemized list of what was stolen, the policyholder exaggerates the list in order to receive more. Hard fraud, which is the more severe, is the deliberate attempt either to stage or invent an accident, injury, theft, or other type of loss that would be covered normally under an insurance policy. One example would be if someone were to intentionally crash their vehicle in order to file a claim for an illegitimate accident in order to collect cash for the damages. There are many other examples for all lines of insurance, such as homeowners. We can use the same individual before who had a homeowner's policy, but instead of someone breaking into their home, they instead staged the robbery themselves in order to submit a claim and collect for items that were never really stolen. Two other categories surrounding insurance fraud are in the health and life insurance sector. Example of life insurance fraud would be applicants misrepresenting themselves on applications regarding their income or medical history in order to qualify for policies they normally would not. On the opposing side, an agent may lie on an application for a customer regarding their health history or income in order to sell a higher valued and more expensive policy to benefit them to receive a higher commission. This benefits obviously them versus the policy that's best suited for the consumer. A more severe type of fraud is the targeting of seniors and having them replace their existing life insurance policies for higher premium policies solely for the agent to gain a high commission. This can be detrimental for seniors on fixed incomes who cannot afford the new policy and ultimately have given up a better one that better suited their needs. When it comes to fraud in the healthcare sector, the National Healthcare Anti-Fraud Association estimates losses due to healthcare fraud in the tens of billions. Examples range from physicians billing insurance companies for services that were never received, or physicians performing unnecessary services just for the purpose of receiving insurance payments. On the individual level, this would be falsifying a statement or omission line that affects their qualifying benefits. Now, when we look back at all the examples that we've discussed, all of the perpetrators in these scenarios have the same motive, which stems from a hedonistic view of financial gain and the lack of moral responsibility for the consequences their actions have on others. We hope to see these patterns lessen over time with the help of legislation in place to combat insurance fraud. Local state governments and the federal government recognize insurance fraud as a crime and outline punishments for those found guilty of insurance fraud based on the severity or the total damages lost. Majority of states classify soft fraud as a misdemeanor and may be punishable by a year or less in jail, fines, community service, and probation. Hard fraud, on the other hand, is a felony with more severe punishments such as a year and more in state prison, larger fines, and restitution. Today we cover movements within the federal legislation over the course of the past few decades that has affected the insurance sector. The first being the Gramm-Leach-Bliley Act of 1999, which assures the security of customers' personal information given to insurance agents and brokers and the sharing of information with third parties. Now, another act that was proposed in 2006 but did not pass was the proposed National Insurance Act, which would have established an Office of National Insurance with divisions of insurance fraud within the Department of Treasury. There is also the well-known Patient Protection and Affordable Care Act of 2010, also known as Obamacare, which reduced the cost of health care, offered subsidies, and eliminates denial of coverage for individuals with pre-existing conditions, which makes health insurance an opportunity for those who were denied or could not afford it in the past. In 2010, Congress passed the Dodd-Frank Act, which, as we know, passed as a response to the financial crisis of 2007 and 8. Specific impacts this had on the insurance sector were Title V and Title I of the Act. Title V established the Federal Insurance Office, who is responsible for monitoring all aspects of the insurance industry. Title I created the Financial Stability Oversight Council, who monitors the financial markets, which include the insurance industry. I want to now review a few of the many groups and organizations that are set in place to detect, monitor, and minimize insurance fraud. The first is the Federal Bureau of Investigation, better known as the FBI, which was established in 1908. The FBI has investigative jurisdiction over violations of more than 200 categories of federal crimes, including insurance fraud. The second is the National Insurance Crime Bureau, which was formed in 1992. This is a nonprofit organization whose members consist of a network of over 1,100 insurance companies. They work with law enforcement agencies as well as the public to help identify and detect insurance fraud. The Coalition of Insurance Fraud, which was founded in 1993, is a network of insurance companies, government agencies, and consumer interest groups that work together to educate and empower consumers to fight against insurance fraud by educating them on how to better detect fraud and to report it. Their website is also a great source where consumers can find scam or fraud warnings and find advice regarding fraud and how to report it. There is also the National Association of Insurance Commissioners, which was founded in 1871 as a response to the lack of correlation of insurance regulation between companies across the country. The first major step was the creation of a uniform way of financial reporting for insurance companies. Today, the NAIC is responsible for creating the Statutory Accounting Principles, or SAPs, which insurance accounting is based. The NAIC state insurance regulations establish standards and best practices in which each state decides whether to pass. They also assist at the national level to pass policies. They have an overall goal of creating uniformity in laws across the states, making it easier for companies in each state to abide by their state laws. There are many other organizations, too many to discuss today, that work to help consumers detect and enforce regulations regarding insurance fraud. What we will conclude on is how insurance fraud is being perceived today and modern ways being used to combat fraud by insurance companies. A study by the Insurance Research Council shows that a significant number of Americans still believe it's okay to exaggerate insurance claims. This could be due to a number of reasons, such as retaliation against a bad customer experience with an insurance company, or feeling entitled for receiving premium payback if they've never had a claim, or a more serious need for benefits due to a recession. We could possibly see insurance fraud decline over time as there has been a rise in the awareness of insurance companies to use technology to detect fraud. With the expansion of social media, it has been easier to detect if someone is lying regarding claims by oversharing information. This has been specifically helpful in workers' compensation and health fraud claims. The implementation of telematics or devices placed in vehicles to monitor how a user is operating will deter individuals from lying regarding an automobile accident. Prevention of fraud at the point of sale is becoming better prevented with the increase of use of online applications and increased performance of analytical systems and information collection through these systems. By the time an applicant has completed their online application, say for auto insurance, the system is able to run an insurance-related fraud background check on that individual. Overall, companies have become more aware of the necessity to combat fraud from within by increasing fraudulent awareness to employees and consumers. Some have created campaigns to educate consumers on what insurance fraud is and encouraging them to report it. This also helps inform consumers of the penalties of insurance fraud to deter them from committing and the effects fraud has on others. As time goes on, we hope to see the percentage of fraudulent insurance claims decrease and more detected, as this not only influences us as consumers, but it financially impacts society as a whole. That concludes my presentation today, and I thank you for listening.